As my regular viewers know, I love high yield investing. I love investing in high yield stocks really because they have a lot of strengths for them, especially because they tend to be much easier to value. You get that high current yield, so they don't need to generate a lot of growth in order to still deliver a satisfactory total return. So you're not having to speculate about future improvement in the business, sustained growth rates of 20% or higher for 10 years into the future. You just need steady mid-single digit growth rates along with an attractive mid to high single or even in some cases a low double digit yield, and you're going to do just fine. You can take advantage of Mr. Market's volatility to sell stocks when they're in favor and buy stocks that are still quality but out of favor, and you get that capital appreciation on top of the growth and yield to get mid to high single digit teens annualized total returns. And that's what I've been able to do over time. And in this video, I'm going to show you that while I do love high yield investing, again, the key point is the valuation component, so you can take advantage of that valuation multiple expansion. So as a result, I try to steer clear of the ones that are currently being overrated and focus on the ones that are underrated. And so in this video, I'm going to share with you 2 high yield popular dividend stocks that I'm avoiding right now because I think Mr. Market is overrating them, as well as 2 that I think are overlooked by Mr. Market and that I am buying instead that I think are undervalued. I'm also going to share how I evaluate yield, quality, balance sheet strength, and upside when I look at these stocks, and ultimately help you to build a high yield portfolio for passive income and long-term total return. Before I get into these names though, I just want to introduce myself. My name's Samuel Smith. I run the top ranked investing group on Seeking Alpha called High Yield Investor, and I launched this video channel about a year ago to share my unique approach to dividend investing with a larger audience like you. So if you like this content and you want to get more of it in the future, could you please just do me the favor of giving this video a quick like, subscribe to the channel so you can get more of my content when I release it, so it's fresh and you can get it when it's most relevant to help you on your dividend investing journey. Thank you very much. All right, let's get back to the video. All right, so the overrated high yield stock number 1 is going to be Aris Capital Corporation. Now, Aris Capital Corporation has a tremendous track record. It has beaten the market over the long term. It has an attractive dividend yield of about 9% that I do not think is going to be cut anytime soon. And so many investors may say, hey, stop right there. You sold me on the stock. Good long-term track record, 9% dividend yield, good management team backed by Aris Management, the alternative asset manager. What's not to like? Well, the reason I don't like ARCC right now, even though I do like the company, I think it's a great company, and you can't deny the track record, is it charges one of the highest fees in the entire BDC space. So that means that it already has an increased threshold to deliver outsized performance just to break even for investors. Second of all, its price to NAV ratio has gotten quite high compared to, historically it's only traded roughly in line with NAV because it has a good track record, but its fees are high. So the market kind of says, okay, it cancels out, we'll charge you what the underlying portfolio is worth. But today it trades at a double-digit premium to its NAV on a percentage basis. And so I think it's gotten pretty expensive, especially because you can buy other high-quality BDCs that charge lower fees at NAV or even less than NAV. On top of that, BDCs are facing some headwinds. You've got the issue of the Fed cutting some rates recently. You've got yield compression taking place in the space because so much capital has come in, and that's hit ARCC as well. And you have the threat of a potentially weakening economy, and ARCC itself is more aggressively positioned than some of its peers. It has more equity and junior debt exposure than many of its peers do. And so when you put all those factors into consideration, if anything, I think that BDCs and ARCC included should trade with inline or at a discount to their historic averages instead of at a significant premium. And some peers are trading at inline with or at a discount to historic averages. And so I think paying up for ARCC does not make much sense. The other overrated high yield stock right now is Kinder Morgan. It has very stable cash flows, about 95% hedged or fee-based cash flows from its contracts. It's got investment grade balance sheet that's really made a lot of progress in deleveraging recently. But while of course the market has priced it up because of its exposure to natural gas, which is expected to benefit from the data center boom, it has a relatively low dividend yield of below 5%, which is quite low for the midstream space. Many of its peers have 100, 200, 300 basis points higher yields than them. Their dividend growth is very poor. It's only expected to be at about a 2% CAGR. That's what it's been in recent years. It's likely to remain that for the foreseeable future. Again, many of its peers have 200, 300, 400, even 1,000 basis points faster growth rates right now in their distributions. And so when you combine all that together, you get a relatively unattractive proposition. Meanwhile, on the underrated side of things, one BDC in contrast to Aris Capital Corporation that I like a lot right now is Morgan Stanley Direct Lending. It currently trades roughly in line with its net asset value, in contrast to ARCC that trades at a huge premium, has very low PIK income, some of the lowest in the entire sector, which means that it's getting its cash flows payments for its loans in actual cash, not in additional debt interest in the company. So again, much more conservative approach. It has a very low leverage ratio that's lower than ARS Capital Corporation's. It has much more exposure to first lien loans with 97% of its portfolio in first lien senior secured debt. It also has very strong management alignment along with some of the lowest fees in the sector, whereas ARS Capital Corporation is some of the highest. MSDL, or Morgan Stanley Direct Lending, has some of the lowest, and Morgan Stanley, the manager, owns about 11% of the equity. So as a result, you get one of the highest quality BDCs, some of the lowest fees, and a very attractive valuation, along with a 10% plus dividend yield, which is materially higher than ARS Capital Corporation's. Plus, MSDL has been paying out supplementals. ARS Capital Corporation has not been. So that further boosts the dividend yield to close to 12% for Morgan Stanley Direct Lending right now. The other underrated high yield stock I like, again, in contrast to Kinder Morgan as a midstream, is Enterprise Products Partners. Its distribution yield is over 6%, which again is like 150 basis points higher than what Kinder Morgan currently offers. It has an A- credit rating, which again is better than Kinder Morgan's. Its leverage ratio is lower than Kinder Morgan's. Its distribution growth rate has been stronger and is expected to continue being stronger at about a 5% CAGR as opposed to Kinder Morgan's 2% CAGR. And it's well diversified. Yes, it has natural gas exposure, but it also has NGL, petrochemical, oil, refined products exposure. And so it's very well diversified. And so here, as opposed to KMI, you get a better yield, better distribution growth, better balance sheet, better total return potential. You get 33% insider ownership at EPD as well, making them very well aligned. And so here, again, as a recap, I do focus on high yield stocks with very sustainable payouts, strong balance sheets, and inflation resistant business models, aligned management, and long-term upside. Okay, well, you get that with all four of these, but the difference is ARCC and KMI are overrated by the market. They are overvalued right now, and peers like MSDL and EPD are significantly undervalued relative to them without sacrificing any quality. And so it just doesn't make sense to me to be buying ARCC and KMI, even though I have nothing against those companies. Right now, at these valuations, when you can buy the likes of MSDL and EPD. And so hopefully this video was helpful for you and how you think about investing in stocks. It's not all about the quality, and it's not all about valuation either. You need to marry the two effectively, and that's what I try to do in my portfolio at High Yield Investor, and that's how I've been able to generate long-term annualized total returns of close to 20%. So again, if you like this video, please give it a like, subscribe to my channel to get more ideas like this in the future. Thank you so much. See you next time.